Good morning. Thank you for joining this morning's 10 a.m. webinar. We're going to have another one of these at 1 p.m. Pacific time. We're going to go over the self-directed 401k, also known as the solo 401k. We're going to talk about the benefits, the eligibility requirements. I'm also going to answer questions here in the live chat. Keep in mind, this presentation is for informational purposes. We're not selling investments, providing investment advice, or providing legal advice. As always, you can join the conversation whether you're an existing client or not a client. It's free to join. You can join our community, which is my solo40.net/my community. We have lots of forums out there I'm constantly replying to. We have over 31,000 members out on the community. It's a very, very good resource, and it's available to both existing clients, new clients, and anyone out there that wants to join. So in order to qualify for a solo 401k plan, you have to meet certain eligibility requirements. The first one is you have to be self-employed in a business where you are the owner-only employee, and you cannot employ any full-time non-owner common law W-2 employees who work 1,000 hours or more. There's an exception for spouses of the business owners. They can participate in the plan as long as they're working in the business, but they are not required to be owners in the business. Here's an example of a participant plan. This is where, let's say, there's only one owner of the business. So this particular slide here illustrates how the plan is sponsored by the self-employed business. So if you have an S corporation, the business sponsors the self-directed 401k, aka solo 401k. And then there will be three separate holding accounts, aka bank and or brokerage accounts, to hold this participant's source of funds. Source of funds being pre-tax funds, Roth funds, and voluntary after-tax funds. So three separate holding accounts for each participant. So here, this is a one participant plan. Of course, you're not required to make all these contribution types to the plan. You can choose to make one or the other, or some and not the other. The plan already allows for these contribution types, so whether you contribute to them now or later, it's still going to be a feature of the plan. So it's not a situation where if you don't do it now, you can't do it later. This slide here is an example of a two-participant plan. So here, you're going to see that instead of three separate holding accounts, a total of 6 holding accounts would be opened, 3 for each participant. Each account is pre-tax, Roth, and voluntary after-tax. Also, both participants are not required to contribute to the plan each year. They contribute one year, the other may not contribute next year. So it's not a matter of having to contribute, it's a matter of knowing that you can make these contribution types, because a self-directed solo 401k from my solo 401k financial is robust, and it allows for all these contribution types. The solo 401k setup process is very straightforward, make it very easy. You have an online application that you would fill out. That's how we collect information, so we can prepare the plan documents. So step 1 is you complete the application. Step 2, we drop the plan documents, and we send you a download link. You sign, you upload them, and then under step number 5, we will help you open up the bank or brokerage accounts for the plan. The plan will have separate accounts titled in the name of the solo 401k plan to hold those funds. So that's where these slides come into play. One plan, but separate holding accounts for each participant and for each source. And then after that, it's time to fund the account, whether you fund it by making annual contributions or transferring former employer plans or IRAs into it, or if you're restating an existing plan from a company like a Census or Fidelity or Schwab, we would help you restate that plan into this solo 401k as well. So here are some things you want to consider when opening a solo 401k plan. How many participants will be in the plan, the types of funds that you're going to contribute, the types of investments you're going to make. Our plan allows for both equities like stocks, index funds, as well as alternative investments like cryptocurrency and real estate and private syndicates, to name a few. And then you want to consider whether you want to open up a bank or if you want to open up brokerage accounts for the solo 401k. So bank versus brokerage accounts. Typically, clients will open up brokerage accounts instead of bank accounts because the self-directed solo 401k plan that's opened with this allows you to use any brokerage firm. So if you use Fidelity or Schwab, for example, they'll give you a checkbook so you can use that to place alternative investments like real estate or private placements. And you'll be able to invest from the same brokerage accounts and equities. So it's one-stop shop. Other things to understand is that you can transfer former employer funds to the 401k, whether it's a 401k, 403b, savings plan, 457b governmental plan, a defined benefit plan, or a pension. You can also transfer traditional IRAs as long as they're not Roth IRAs, because Roth IRAs are not allowed to be transferred to a solo 401k, even the Roth solo 401k portion. You can transfer a former employer Roth 401k, 403b Roth, Treasury Savings Plan Roth. Those can be transferred, just not a Roth IRA. You also want to make sure you review the eligibility checklist when you're looking to open a solo 401k plan. For instance, any entity type can establish a solo 401k. What matters is that you're self-employed in the business. So it can be a sole proprietorship or it can be a formal entity like an LLC or an S corporation. You do need to report that self-employment activity on your tax return. So it could be the Schedule C, or it could be the 1120S if we're talking about an S corporation, or if we're talking about a partnership that sponsors the business, it would be Form 1065. Your spouse can also participate in the plan, as I mentioned earlier, as long as he or she is also working in the business. You can also have a solo 401k plan, even if you already have a 401k plan through your daytime employment. Of course, contributions to the solo 401k plan will be based on your net self-employment income from your side business, so the self-employed business. You are going to need a separate employer identification number for the 401k. Well, you cannot use your social security number or your business EIN. That employer identification number for the solo 401k is going to be used when processing your forms such as Form 1099R, which is used for distributions and conversions, especially that mega backdoor Roth solo 401k conversion that's been so popular with our clients since 2014. That Form 1099R will need to list the EIN number for your solo 401k. Okay, let's keep moving on here. So why would you want to open up a solo? As I mentioned a little bit already, you can invest in alternative investments as well as equities. So alternative investments is real estate, promissory notes, precious metals, private placements, cryptocurrency, and so forth, to name a few. And that's where the checkbook water control comes into play. So with the self-directed 401k from my solo 401k financial, you're going to be able to still invest in equities while also having the option to invest in alternative investments. You can choose to invest in one or the other. You're not required to invest in both equities and alternative investments. Also, a self-directed solo 401k is great for making high contributions. For 2025, for instance, the overall contribution limit is $70,000. You can make pre-tax contributions, Roth solo 401k contributions, as well as the new Roth employer solo 401k contribution type resulting from Secure 2.0. And of course, you can make voluntary after-tax solo 401k contributions as part of the mega backdoor. Many clients will forego making the other contribution types and solely make voluntary after-tax solo 401k contributions, which is again at $70,000 for 2025. So you could contribute the full 70,000 to the voluntary after-tax solo 401k, and that will maximize all of your solo 401k contributions for the year, and then turn around and convert it to the Roth solo 401k or the Roth IRA. This slide here talks about the 2024 solo 401k contribution limits, as well as the 2025 solo 401k contribution limits. You can see here that in 2024, the overall contribution limit is $69,000 plus a $7,500 catch-up for age 50 or older in 2024. You can also make those contributions for 2024 in 2025 by your business tax return due date plus timely filed extension. So this slide here talks about the 2024 solo 401k contribution limits, and you can see that it applies to both employee and employer contributions. So if you have a plan in 2024, you're going to have until your business tax return due date plus extension here in 2025 to make those 2024 contributions. For 2025, the contribution limit increased by $1,000 to $70,000. The overall contribution limit is $70,000. And if you're age 50 or older in 2025, you can also do a catch-up amount of $7,500. So that stayed the same as 2024. However, one addition to the catch-up contribution rules that's effective for 2025 and later years is the new super catch-up contribution that only applies to an age group that is in the age group of 60 through 63. Instead of contributing the $7,500 catch-up, now it's increased to $11,250. So you can contribute one or the other. You can't contribute both, obviously. And of course, anyone that opens a solo 401k plan in 2025, or if you have an existing plan, you can make contributions in 2025, both employee and employer throughout the year, or you can do it next year in 2026 by your business tax return due date plus timely filed business tax return extension. So this slide here covers those 2025 contribution limits, or contribution deadlines, I should say. The self-directed solo 401k also allows for participant loans where you can borrow from your own solo 401k plan up to the statutory limits, which is 50% of your solo 401k balance, not to exceed 50,000. Now, what's great about the participant loan is that both the interest and principal flows back into your own 401k. So you're not paying my solo 401k financial or the bank or the brokerage firm. You're paying your own 401k back. And each spouse in the plan can borrow from the plan. So if you have a participant plan and both spouses have funds in the plan, each can borrow from their respective solo 401k funds, conceivably being able to borrow up to $100,000 between both participants' funds in the plan. Long term is typically 5 years, unless you use the proceeds towards the purchase of your primary residence, in which case it can be extended to a 15-year loan or a 30-year loan payback. Here's some more good information about the solo 401k participant loan rules. It's got to be documented. The IRS regulations require specific loan documents prepared, which we'll prepare as part of the ongoing support. And there's going to be a loan application built into it along with the loan agreement and, of course, the amortization schedule. We go to the loan application, there's no credit check, there's no, I mean, essentially you just got to make sure you have enough funds. So you're borrowing from your own plan, so there's no credit check that comes into play. And of course, we went over the rules here, so you got to make sure you make those payments back into the solo 401k plan from your personal bank account. That's the ongoing participant loan payments. They can be made quarterly or monthly. And the interest rate is typically the prime rate plus 1%. The typically rate used, and it's a fixed rate for the life of the loan. As we touched on earlier, you can utilize the solo 401k to consolidate your former employer plans and IRAs. That's another common usage of the solo 401k is to consolidate all your retirement plans under one umbrella. And of course, the mega backbone, the solo 401k offered by my solo 401k financial not only allows for in-plan pre-tax solo 401k, but also the mega backbone Roth solo 401k with make voluntary after-tax solo 401k contributions to that voluntary after-tax account under the plan and then immediately convert it to the Roth IRA or the Roth solo 401k. This slide here illustrates the 5 steps involved in the mega backdoor Roth solo 401k, where of course you open up that designated voluntary after-tax account under the plan, and then you make the contribution, the voluntary after-tax contribution, and then you convert that to the Roth IRA or to the Roth solo 401k. You get to choose, and then you need to fill out our online conversion form under step number 4 so that we collect the necessary information to issue the Form 1099-R to the government under step number 5. So again, our clients have been processing the mega backdoor Roth solo 401k since 2014. Another thing to consider when opening a self-directed 401k is where you're going to hold the funds at. It can be held at your local bank, credit union, or they can be held at Fidelity or Schwab. Many of our clients use 2 brokerage firms. We're neutral as to which brokerage firm you use. What matters is that the brokerage firm will allow for it, and these 2 brokerage firms appear to be the most popular ones. We've helped clients open thousands of holding accounts at these institutions with their self-directed solo 401k plan. Typically, clients seem to gravitate towards Fidelity because they can open up those brokerage accounts online once we've established the plan. And of course, with Schwab, they have to be faxed in. We can fax for you once we draft those. And then with Fidelity, you can typically make contributions a little more easily than with the brokerage account at Schwab, in that Fidelity will allow you to link your bank account to your solo 401k brokerage accounts at Fidelity under what's called non-prototype investment only brokerage accounts. So you can make contributions electronically. So it's ACH. You're set up at your bank, that way you link your bank account to your Fidelity brokerage accounts to make those contributions. Whereas with Schwab, you typically have to open up a personal brokerage account at Schwab and have the contributions flow from that brokerage account at Schwab to the solo 401k brokerage account. So it's a little bit more convoluted. But again, our clients get to choose where they want to hold their funds at. And many will open them up at Fidelity, and they will also use Schwab. So it just comes down to why you're comfortable working with which firm. We're neutral on that. So the solo 401k also comes with the auto contribution credit. So if you set up a plan here in 2025, you're going to qualify for that auto contribution credit, which is a total of $1,500. It's $500 increments spread out over 3 years. So you would qualify for it in 2025, 2026, and 2027. $500 in each year. And not all solo 401k plans have that auto contribution feature. Our plan has had it built into it since the middle of December of 2023. So if you're a client prior to middle of December of 2023, your plan will need to be amended to allow for it. And we also have to prepare other forms as part of that auto contribution credit requirement. And it's a dollar for dollar tax credit, auto contribution credit. You'll deduct $500 per year for 3 consecutive years, filing Form 8881. What's great about it is that you're not required to contribute in order to have the auto contribution credit available. It just needs to be built into the plan, and certain documents also need to be signed as part of the plan. So you can opt out. That doesn't mean that by opting out you won't be able to contribute. Still contribute you want, up to the overall limit, of course. And the form to claim that yearly $500 auto contribution credit for a total of 3 years in $500 increments. You would file Form 8881 each year. So one for 2025, a separate one for 2026, and a separate one for 2027. You can learn more about the auto contribution credit by referring to code section 45 like Tom, and notice 2020-16. Now, self-directed from solo 401k from my solo 401k financial is ideal for those that are looking for not only a company that will be the plan document provider, which is why we charge an annual fee of $125 as for being the plan provider, but we will also include in that annual fee of $125 other reporting, such as Form 5500 Easy reporting and Form 1099R reporting. For Form 5500 Easy reporting, that form applies once the market value of your solo 401k plan is greater than $250,000. So therefore, you have to add up all the balances in your plan to determine if the Form 5500 Easy applies. So if you're a one participant, you're going to want to look at not only your pre-tax bucket, but all your buckets. You're going to look at your pre-tax, Roth, and voluntary after-tax buckets. When you add these buckets together, including any investments, if the market value is greater than 250,000, then that means a 500 easy will need to be filed. Same thing with the two participant plan. You need to add all of the participants' plans or funds in the plan, I should say. So here, if we've got a two participant plan, for example, both spouses are participating in the plan, you need to add all 6 holding accounts balances to determine if that 250,000 greater threshold has been met. And as a result, the Form 5500 easy will need to be filed. So back to that slide here. Get back to it here. So for instance, the filing deadline for Form 5500 easy for 2024, if your plan year ended December 31st of 2024, is going to be July 31st of this year, so in 2025. And again, you got to add all of your funds in the plan, all the investments to determine if that 250,000 greater threshold has been met. You also have to take into account defined benefit plans. So many of our clients will open up DBKs. That means they have a solo plan with us, and they have a defined benefit plan as well for their self-employed business. You have to add the funds in that defined benefit plan along with the funds in your solo 401k, and if added together, then you're going to have to file 5500 easy. It's going to result in 2 returns. 5500 easy for your defined benefit plan, your defined benefit plan provider will file, and then the second one for your solo 401k, which we will file as part of the ongoing support, provided that you kindly request that Form 5500 easy. We don't have access to your funds, so as a trustee of the solo 401k plan, the responsibility falls on you. If you want us to prepare that Form 5500 easy, and then we'll file it electronically with the government. So you need to kindly request that. Let's also talk about the next filing. A Form 1099R also applies if you process a distribution or a conversion from your solo 401k, which means that if you took a distribution from your solo 401k in 2024, then the Form 1099R needs to be issued by next month to report that taxable distribution to the government in 2024 distributions. Same thing for conversions. Converted funds, whether it was Mega Backdoor, Roth Solo 401k, or pre-tax Solo 401k funds, the Roth Solo 401k in 2024, that needs to be reported on the Form 1099R as well. So it's very important that you keep up with these requirements. And again, we're here to assist with the Form 1099R and 5500 easy filing requirements. You kindly request them from us because we don't have access to your funds. So as a trustee, you need to let us know. And of course, as I already touched on some of these, the self-directed solo 401k from my solo 401k also allows for participant loans. It's got the auto contribution credit built into it. Let me send over a link, as a matter of fact, that talks about auto contribution credit versus a tax credit. Take a look at this link here. It's a guest post we did on this whitecoatinvestors.com site where we talk about the differences in tax credits. Because the solo 401k plan qualifies for the auto contribution credit, not the tax credit. So take a look at that. That being said, let's take a look at some live questions here. Okay, so we've got a question here from Mr. Che. How is my solo 401k different than the ADP solo 401k? Good question in terms of after-tax contributions. Great question. It's my understanding that the ADP solo 401k, which is my understanding that they charge $1,000 a year plus just to have it, which it's astronomical, but I'm not going to get into cost. From a contribution perspective, the solo 401k from my solo 401k financial allows for voluntary after-tax solo 401k contributions. So the ADP solo 401k, I'm not aware of it allowing for voluntary after-tax solo 401k contributions. It might allow for Roth solo 401k contributions, which is different. Voluntary after-tax solo 401k contributions are different in that they're part of the mega backdoor Roth solo 401k plan. Whereas with the Roth solo 401k, the maximum you can typically contribute to it is on the employee side. On the Roth solo 401k employee side is $3,500 for 2025, for example. Whereas with the after-tax, voluntary after-tax solo 401k bucket, you can contribute up to $70,000 and then immediately convert that to the Roth solo 401k. So now you get 70,000 funds into the Roth solo 401k by utilizing our mega backdoor. Okay, let's see what else we have here. Other questions here. If I transition out of solo 401k practice and have more than 5 employees in the future, will my own business funds get managed? So if you have an existing solo 401k plan and you employ just one full-time W-2 employee who works 1,000 hours or more, then you will not qualify for that solo 401k plan anymore. There's also a part-time rule here, Act 1.0 and 2.0, where if you have a long-term part-time employee for 2 consecutive years that works between 500 and 999 hours, then you also will no longer qualify for the solo 401k. You're going to have to commit to a full-time traditional 401k, which we do not offer. But you would just need to restate the solo 401k to that full-time employer plan and then offer that plan to those participants, those non-covered raw W-2 employee participants. Is the 250,000 filing for money contributed grew beyond 250,000? Yes, the 250,000, the greater than 250,000 threshold for filing the Form 5500 easy takes into account all the funds in the plan, not only contributions but earnings. Those are all part of the plan. So investments, earnings, contributions, you have to add them all together to determine if the market value of this 401k plan is greater than 250,000. If it is, then a return needs to be filed. The IRS charges horrendous penalties in the hundreds of thousands of dollars on filing those, and it compounds on a daily basis. I think it used to be like $250 per day. I forget the amount now. So it really compounds. Here's a question here. I have a business set up using Rob's 401k and have employees. As an employer, can I pay 25% of employee salary towards employer contribution? Can my employees opt out of retirement? If so, a separate in the same Rob's established business? So good questions here. You're talking about the business financing 401k, aka rollover business startup. The 25% is considered an employer contribution, which means it's made by the employer, and as a result, the employer gets a 25% deduction on the corporate tax return. So on the corporation tax return, the corporation can deduct those contributions made to the participants' accounts. So it would not be made by the employee, but rather by the employer, so the corporation. And with the business financing 401k or Rob's 401k, employees can opt out of contributing to the plan. They don't have to contribute to the plan, but they do need to sign that opt-out waiver. And it's not going to be considered um, irrevocable. In other words, they can revoke that later and say, oh, okay, I've decided I want to participate in the plan now. So that's another important item to mention. And no, it's not going to be a separate law. Because remember, business startup 401k is technically a 401k plan that allows for investing in your own business. So it's one plan. Each participant in the Rob's 401k is required to have their own separate holding accounts if you want to participate in the plan. So one plan with separate holding accounts for each participant. Let's see here. Any other questions here? Here's another question here. Is it possible to add a separate business to an existing solo 401k plan? Still no other employees, just a different business line that is set up either as a separate sole prop, more like an LLC. Great question. So yes, under the control group regulations, the solo 401k plan, contributions to the plan have to be based on your aggregate net self-employment income from all of your self-employed activity. So let me send over a link regarding that. So the plan already allows for contributions to it based on your net self-employment income from all of your self-employed business. There's actually a box on the adoption agreement that's checked off that allows for control group contributions where you own multiple self-employed businesses. The contribution based on your net self-employment income from all self-employed businesses. So I'm going to send a link that talks more about the aggregate contribution limits. All right, I think we got through all the questions here. Again, we're going to have another one of these here at 10 a.m. Pacific, excuse me, at 1 p.m. Pacific time today, and we'll be back here again tomorrow. And until then, have a good rest of the day.